Hey, what's up, guys?
Howdy.
How's it going? Gonna see if anybody else is gonna hop on. Yeah, Reagan. Whenever I think who posted it, Joe posted that volume profile. I was wondering if those plots are the previous day or the current day.
I don't know if you're talking about like the screenshot I posted this morning. That was a different indicator than the one that we're messing with now, because the indicator I posted this morning is one that's built into NinjaTrader, and it's a volume profile one, and it shows volume area, etc. So this one we're messing with now is the value area one. It actually sets plots and I'm not exactly sure what the hell it's basing them on, to tell you the truth, but it will draw the current value areas just like how the other one will. So we're trying to figure out how to get draw those plots, those value area lines. What the strategy builder looks for as a condition, for greater than equal to crossbow, blah blah blah.
Mm-hmm.
So I can't target a drawing in strategy builder, but you can target a plot, just like
Yeah.
how just how to target an EMA or something. So that's what we're messing with, is trying to, since this code already has both. It's drawing the volume area high and the volume area low, and it's drawing plots. It's just not drawing them in the same damn place. So I'm trying to trying to get that to work so that it'll draw the current session ones, because then we could target them, and then the rest of the experimental algo would be easy peasy from there. I've already got the rest of it. I just set a variable for broke value area equals true. If price goes below or goes above value area low, value area high, flip the variable to true. And
Mm-hmm.
so the next I'm going to do is, if all conditions are met, VA is true and price enters into there, and then do something about 3 bars on a 15-minute chart, then go longer, go short, whatever. That all falls into place easily from there.
Yeah. So you just really needed to get those plots, I guess.
Yeah, that's what we're messing with. Trying to dig it out, because it's all right here in this code. We're just trying to figure out how to do it. Like, neither of us are super familiar with NinjaScript itself, super programmers, but
Mm-hmm.
I don't know, we're stumbling our way through it.
Hmm. Well, I'm sure if y'all keep on cracking down on it like y'all are, it won't take just terribly much longer because y'all
So
been going crazy with it.
the cool thing is, if we can figure out how to turn these rendered drawings into plots, that really opens up the ability to change some things. Like anything that was a drawing tool before, now we can turn it into an indicator, like the Fibonacci extensions that I talked about. My other idea, you know, I
I
I got
actually I actually already have the hookup on Fibonacci, so
okay.
you don't have to worry about that one. But definitely, obtaining that knowledge on how to kind of, I mean, just I would assume that the indicator or just putting out a drawing and it putting out a plot is like two very different things,
I mean,
despite
very
them being
different,
the
but
same
also
value.
very the same. It's literally just telling it how to recognize them. Like how it that's what we're trying to wrap our heads around at the moment. Like they should not be that different. It's just telling it that one thing is a thing it can fuck with, and the other one is just a visually rendered thing. So
Yeah,
yeah, we're
it sounds super frustrating.
yeah, it's fun. Yeah, I mean,
Let's see real quick. All right, I guess we'll get started. Um, Going to check out some variations of the opening range breakout and compare that to the results we have here. So what I mean by that is just looking at some different ways to get that initial testing for this pattern. I have some simple ways I want to test out here in the notepad. So I just closed everything. I don't know how that works. Or minimize everything. But so right now we're entering on the break of the range and exiting on the trend change, which is we're using the ATR trailing stop. So the first modification I want to make is I want to make a variation where we still have the same trigger, so we're still entering on a close above the opening range high, but now our exit is just the session close. So we're just holding until the trading session is closed. And then we'll have an additional stop. So essentially we have two stop losses. The first one being a close when the session is over, which would basically be our close in, kind of like how the ATR was allowing our position to run and then closes off for a big payday, a target essentially. And so we're hoping here that on days that it breaks above the opening range, that price will keep on going until the close. And our stop loss is essentially, for the first variation, is whenever the close crosses below the high. And then we're going to see how it works if we close when it closes below the midline, the low, the opening range low, and the open price. So it's two stop losses, one for a target and one for a loss. Whereas the first variation pretty much acted as both. The ATR trailing stop was our initial stop for a loss, as well as a stop for a target. So if y'all don't fully understand that, you can just type it out or just talk over the mic. That'll be fine. So let's go ahead and make the first one. We're going to run through these pretty quickly. They're all very similar. So I'll probably make a variation of the first one. So we'll go back to our strategy and we'll just click save as. One. Go to the conditions. So the trigger is the same. Cross above opening range high. Has to be greater than, well, for me, it's 9 a.m., which is after the opening range is established. And then we can remove this ATR. We can remove that ATR. And then the second condition, because our exit on session close is already built into the strategy analyzer right here. So all we need to do is make a condition for the close beneath the opening range high. So we can copy and paste. Change the comparison, so cross below opening range. I'm gonna go ahead and choose the high. Now I don't expect this one to do very well, but I mean, who knows? We don't know until we test it out. So I'm going to keep this one open since this is basically our current baseline. We're just going to open up another analyzer, set it up the same way. Orb video 1. Going to do 2 to 5. 0.5. Choose the index basket. And we're going to test it on the 5, or from the 2 minute to the 5 minute again. We're doing the last quarter of 2022. Include commission, aggregate, accident profits. Everything looks good. X down session closes checked. So cool, let's go ahead and run this on the 5 minute. So not very good. Let's test out the 4 minute. Still not very good. Let's do the 3 minute. Even worse. Let's check out the 2 minute. So there we go. We got our answer that, just exiting when it closes back beneath the opening range high definitely isn't optimal, because this right here happens a lot, where it just closes up and it wants to retest, or if there's pretty much any amount of noise, then we're going to get stopped out, and then it's going to re-enter, and then it's going to get stopped out, so pretty easy to see why this doesn't work. Only scenarios where it's going to work out really well is whenever price just breaks above that opening range and just keeps on going up, all perfectly, which of course doesn't happen that often. So now let's go back to our exit, and let's change it to the midline. Midline I would expect to work a little bit better, because using the midline would actually invalidate the strategy overall. It would tell us that an opening range breakout definitely did not occur, because if it does occur, then it's going to keep on going and not come back down and cross beneath that midline. And that concept is even expanded whenever you compare it to the low. If price breaks above the opening range high, goes all the way down to the low, then that's just confirmation. That's slapping you in the face that the opening range breakout did not occur. So we compiled. Now we can test it on the 5 minute. And you can see here is why using limit orders will be good, and we'll eventually add limit orders, because whenever you use the cross below, these massive red candles can occur, and then you have to basically hold it out and then wait until it closes. And so instead of just actually risking that midline with a limit order, it will actually be a stop order in that case. But no good on the 5 minute. Let's see, the 4 minutes. Not as bad as using the opening range high. And down to the 2 minutes. No good. Let's go ahead and change it now to the opening range low. Of course, another thing that we're susceptible to without even looking at the chart, since we're just holding until session close, we're very susceptible to whenever price, goes up a lot, maybe with a breakout, but then maybe during, lunch, power hour, whatever, it can retrace all the way back down and then stop us out. It's like somebody posted something probably over here. Yeah, definitely some potential there. Potentially using the opening range as a mean and looking for price to fall back into it. It's definitely a good potential strategy idea. I think did I change to the low? Let me just recompile it. Now we're going to be testing out the low, opening range low, compile. Once again, let's check out the 5-minute. Definitely a lot better results than using the other two lines, but still not as good as our baseline. I think that profit factor is almost higher. Oh no, it's not. Not even close. So oddly enough, we're getting very similar P&Ls across these time frames. All right. So this variation definitely not that good. So now what we're going to do is use the same concept, but instead of exiting on close, we're going to add back in that ATR change. So the ATR change is going to be essentially our, our exit in the money, whereas these are going to be our exits for a loss. Just go to the builder, and what I'm going to do is choose the other one. I think what I can do is I can close this builder out and go to a new builder. Here is it? Orb video. I'm going to save the original orb video again. So orb video 2. So we're keeping that initial exit, all right? And the only way that's going to work is if we keep it over here as well. So actually now we're just adding on to this one. And the way we can do that is add, we copy and paste this cross of the opening range. So cross below the opening range high. And the thing you have to do here is change this box to if any, or else it won't work. So now we're saying if the trend changes, or if we close below the opening high, then go ahead and exit instead of all, whereas that just wouldn't even work right. So if any of these conditions occur, we exit our long. Just go ahead and compile. Choose orb video 2. Set our parameters. Everything looks right. Change it to 5 minute, include commission, aggregate, net profit. Cool. Should be right. Let's check out the 5 minute. 51 on 5, so definitely a lot better results already. Let's check out the charts, see what it looks like. Considering the opening range high was the worst one, this isn't just absolutely terrible. We see here we close above the high. Can't see the wicks. I like seeing the wicks. So I'm going to change this to gray. So here, and don't pay attention to the arrows. Remember, these arrows are just the change of the trailing stop. But here we closed above, so we opened at the following open price. But of course, we're still susceptible to any type of noise. And that's the EMD. EMD has really gappy, botchy price action. Here's an example of it's a really good opening range breakout. Breakout above, and then left a lot of profit on the table. I have to make a condition for that later on. But captured a good amount of profit there. It's like it's 60 points, about that. So it is operating the way it should. Let's test it out on the 4 minute. I think that is our lowest drawdown yet. And it is, so that's really interesting. We have more trades and a lower drawdown, and the profit factors across the products are really consistent, which is also a really good sign of robustness. I really like how these profit factors are close, and almost similar drawdowns as well. And so the average drawdown across these is probably the same as the max drawdown on the portfolio. Where are these messages coming from? Right here. And just go ahead and post chat in the general chat. Actually, I might just make a new channel and just call it like the live stream chat, so that everybody just knows where to go during live streams. Yeah, so right now what we're doing, as you can see I wrote them out on the notepad, is there's 2 exit conditions. One is to exit us on a large trend in the money, and the other is to exit for a loss. So this is actually the original strategy. We're just adding an additional exit. We're still exiting on the ATR change, and now we have an additional exit where we close beneath the high for this specific one, which is proving to be pretty good. Lowest drawdown yet, with really consistent performance across the products. And then we'll be testing, on the mid, the low, and the open. You didn't understand? Does that mean you understand now? So you can remember the initial way that we exited, right? We were exiting on the ATR change, right? Cool. So all we did was add an additional exit. And that exit being if we close beneath the opening range high. Remember, our entry is whenever we close above the opening range high. So now we're saying, look, we close above the opening range high. If it closes back beneath it, then we're going to exit our trade. On the flip side, let's say it keeps on going, right? Let's say we open our trade and it doesn't close back beneath the opening range high. It just keeps on going. In that case, our ATR change will be the exit whenever price decides to pull back enough to change the ATR. So that's why I say our ATR is our exit for the money, for our target, whereas the close beneath the high will be exiting for a loss. Sweet. So yeah, I'm pretty interested actually with the results we're getting here. It's honestly a really close call on which one I would say is better, because you see the profit factor on the NQ is really high on this one, whereas the other ones are a little bit lower. You get a 1.3 and a 1.3. So honestly, the average profit factor on both of these are probably very similar. However, this one does have a lower drawdown. So we'll come back to the 4-minute for this one. But we're going to test it on the 3-minute. The drawdown is 4,400. So for that test, we had 58K and minus 4,400. I always just round to the first digit. So 58K minus 4K. Yeah. So you remember what our exit is. Our stop loss is essentially really tight, because we're closing as soon as it crosses beneath the opening range, which is going to cause a lot more trades, which is what we have here, and a much lower win percentage, but our losses are a lot smaller. Correct. And even though we have those smaller, more frequent losses, our drawdown is lower. Now we do get more trades, so our average trade is lower. The average winning trade we can look at is 930. I normally don't look at these metrics yet, but the average winning trade is 930. On the other one, the average winning trade is 1,300. Well, my bad, I'm not going to combine metrics. It's still higher though. Average win to average loss is 1.72. And honestly, it's significantly higher on this one, but once again, we know that's just because we have a much tighter stop loss. So really the core metric I'm looking at here though is the drawdown, or is the return divided by drawdown. That's going to be the main thing I look at right now, is the net profit to drawdown ratio when comparing these strategies. So this is on the 4-minute. let's go ahead and see if the 3 minute gives us even better results. So we got 54K minus, 58K and minus 4,000. So 3,000, or so the 3 minute chart has a lot more noise. Definitely did not help us out for this strategy, because I can just picture the 3 minute, closing above and back below that opening range high much more frequently. And it might be the same case on the 2 minute chart. But we're going to find out. It's pretty much the same results as the 4 minutes. So let's go back to the 4 minute. And what we're going to do so it keeps on going down and down because, the smaller time frame, the more noise there is. So it's going to be bouncing above and below that opening range high. Now, that might not be the case whenever we use the opening range midline next. So I don't want to lose this result because, it's a pretty nice result here. And we can do further comparison, increasing the sample size and other things when comparing it to the baseline to see if it actually is better or if this is just random chance. So we're going to open up another analyzer. Let's go ahead and put in our strategy or video 2 optimization. Let's get 5. Everything's looking good. I'm not going to resave the strategy because it's very simple. We're just changing one little thing about it, so I'll just change it back if these other variations aren't any good. Yeah. A lot of repeatable actions. It's like I was saying, once you get really fast at it, you can test ideas out pretty quickly. So we're going to change the high to the low. Or actually, we're doing the midline next. Make sure it's selected. So seeing as how the opening range high gave us the worst results on our last comparison, I can only assume that the midline will give us better results. So we might actually surpass our baseline results with this test, but maybe not. $55 on 5, definitely not bad, but doesn't beat our other two. And there is the superior result. Very nice. Oh, look at super low drawdowns on RTY and YM. Very nice. This is our lowest drawdown yet. I think it's pretty much the same profit as our baseline, but a lower drawdown, a higher profit factor. You got a better average win to average loss ratio. So very nice. So because we're seeing this, I can go ahead and close out this analyzer, because using the midline has definitely proved superior to using the opening range high. Let's test out the 3 minutes. Three-minute no good. Well, I mean, it is good, but you know, not compared to what we're working with now. Same story with the 2 minute. So we're going to go back to the 4 minute. There's actually a lot of theory as well to why these oddball time frames can often perform superior to the more well-known time frames. But we can get, I'll probably post an article about that one day. It is pretty interesting. I mean, the premise behind it is you see things that the crowd doesn't see and can avoid potential noisy fake outs. Increase the text size. No, I'm not available. I don't even know how to do that, to be honest. Give me 1 second, actually. Okay, I actually didn't realize that because I had the live stream pulled up on my laptop and I thought it was clear, but now I see what you're saying. It's like blurry as shit actually in certain areas. I'm gonna see if it's doing that on the like processed ones, like the ones that are already processed, the replays. I don't think it's blurry on those. But yeah, I'm definitely gonna go back into my settings and fix this issue for the next stream, because that's definitely not gonna work moving forward. Which I'm streaming in, you know, HD, but my screen resolution is 4K. So I think the conversion there is kind of messing with something. But yeah, since you can't see it, I will, I'll be updating you. Okay, so that's what it looks like on the old stream. Yeah, it's not gonna work. I have to fix that. It's probably just some of my settings. I gotta just work with the settings some, and I'll do some trial and error and get that fixed. Because that is no good. But yeah, I'll read out these numbers to you. Yeah, it's some numbers, because I used to do the OBS YouTube setup in previous Discords and never had this issue. So, but I also forgot how I had those things set up. But I'll tell the numbers out as we're doing these tests so that you know. But this is a great result. This is 61K and minus 4K with our highest profit factor yet. 1.66. Pretty much same sample size as our baseline. the drawdowns overall, we got just like $2,000 drawdowns on RTY and YM. But all right, now it's time to. I should have left that other analyzer open, so I gotta keep on doing this. Let's see. Yeah, so net return, net profit is completely useless by itself. Give a shit less if it made 50K or $1 million. All I'm looking at is the ratio, drawdown to profit. That's the ratio I care about. Because, yeah, net profit divided by drawdown. Which, starting out, I want to see at least 10. Yeah. So if drawdown is 5K, I want to see at least 50K. And then as far as what gets my attention, when I start seeing 20K, 20 to 1 plus. Rock says, why wouldn't I just start running this shit tomorrow? Well, in this current stage, like if you test just the general premise of a pattern and it's working, because right now it's not overfit. Nothing about this is overfit. It's in its most robust stages right now. But really leaving a lot on the table in areas it can be improved. And just in this specific context, we definitely don't have nearly enough sample size. We're testing on 1 quarter just to get these initial tests out of the way. That being said, a lot of people will not even run back test if they have a approach that they know isn't an overfit approach. Now you could just make a general premise of a strategy and just start running it the next day. And then after a week, after 2 weeks, you say, well, is it doing good? If it did good, then you increase your lot size. Or I don't use lots, but you know what I'm saying. And you could do that with 10 strategies. You could just deploy 10, simple strategies that aren't overfit, just to exploit a simple pattern. And you just monitor their performance, the ones that are doing good, increase the position size, incorporate some asset filtering. Yeah, definitely a lot more tests we can put this through, Then we get to the robustness / validation phases. It's easy to see a strategy make profit. Now we're going to test or not now, but when we get to that point, you know, we can test various ways. Okay, what makes this strategy just explode? You know, like what has to happen to make this strategy do terrible? Yeah, like overall market regime shift. If the breakout, you know, if the opening range breakout just isn't happening enough, you know, because remember, we're just trying to exploit a pattern. And a pattern like this tends to be prevalent, you know, most of the time across some asset. You know, if I gave you 20 futures products, the more products I give you, the greater chance there is that one of those products are going to have a great opening range breakout the following day. And then as long as your risk is in check on the other ones, then once again you get that advantage of diversification. So where are we at here? We just tested the midline, so now we have to test out the opening range low. Opening range low. Go ahead and compile. Well, the threat to this strategy is a ranging market. As simple as that. Because remember, the premise behind this pattern is if price is going to give a very large uptrend, then it has to break above or break out, you know, of the opening range. Now, in a perfect world, price would just stay in the range and never give us a trigger. But due to noise in a ranging market, it's likely that it'll break above that range a little bit, fall back in, break above the range a little bit, fall back in. And that's the weakness. And of course, we can look at some leading indicators that might actually predict when a opening range breakout is more likely to occur. But once again, we're not at that stage yet. Still just testing out some ways to exploit this pattern. And definitely, if y'all have any other, you know, simple ways that we could, like other initial tests, different ways essentially of quantifying this pattern, then definitely post those in the orb_v1 channel. But anyways, we got a couple more variations to test. So we just got this opening range low. I don't know if I've compiled yet. I'm pretty sure I compiled opening range low. Nope, that's pre-session low. Opening range low. Can you share the strategy? You want me to share the sauce? Honestly, what I would really like to see is you guys test your skills and build this strategy, because it's not hard. It's very simple conditions, especially at this stage. It should take you just a couple minutes just to whip it up. If you can't whip it up in a couple minutes, then that's even more reason for you to whip it up. You know, I'm here to get you guys to my level. I'm not here to, well, do anything else but that. And another thing is, I'm not, sharing too much in the download links right now because right now we still have a lot of floaters. And those floaters aren't worthy of getting some free stuff, you know. But after this weekend, the group will be narrowed down, and you know who I'll be working with. I'm actually kind of surprised at the amount of floaters we have. But that's kind of what I expected because a lot of people, they just get intimidated by trying something new or, um, don't want to change their approach, kind of stuck in their own ways, so to speak, which I don't, I'm not like shaming them or anything, nothing wrong with believing in your approach or your ways or whatever. Um, I had several people though that didn't even, very close-minded. Um, and I don't think that's a good trait to have, especially in the world of trading. You should just be very, very open, especially if it's free. Like I had a couple people, I'm sure a lot of members still just haven't just watched one video. Like, it doesn't make any sense to me, to be honest. Like, just watch a video, see if you like what's happening, and then leave, you know. But even that, for a lot of people, is just asking way too much. But I am dying to test out this opening range low. So let us go ahead and run those tests right quick. So this is an interesting occurrence, but right off the bat, I can see why it's occurring. I don't even need to look at a chart. And you see here on the 4-minute, which is our current best performer, because remember when we use the midline on the strategy analyzer here, on the 4-minute chart, we get these results, the 61,000 with a $4,400 drawdown. Now we're using the opening range low, which would make you think that we're going to have much higher drawdowns because it's much further away. But in reality, what's happening here is you see it chose the 2 for the ATR deviation. So I know right off the bat that in almost all scenarios, this ATR trailing stop is going to be above the opening range low, and probably in most cases above the midline. You see over here where we use the midline, it also chose 2, and in most cases the ATR being set at 2 is going to be above that midline. Let's go ahead and try out 3. Not bad, but not good enough. Interesting. So we have our highest profit yet, and our highest profit factor, but not our lowest drawdown. However, the ratio might be slightly better. Let's see. 66,000 divided by 5,000. That gives us basically 13. So it actually is. So this one gave us 13.5, whereas 2-minute on the other one it gave us. Oh wait, I got my numbers mixed up. Well, this one was 13.2 and the other one was 13.5. So slightly better ratio using the midline. I do want to look at that chart a little bit to just see how often this midline or the trailing stop is above the midline. So don't get the midline confused with the open price. The open price is the thicker dotted line, whereas the middle, the midline is this skinnier one. So here, like I was just saying, the ATR stop was above the midline. So this actually opens up another potential variation, because what I wanted to test here was that I only wanted to use these opening range lines as our exit for a loss. But now this ATR trailing stop is still acting as our exit for a loss as well as our exit for a target. So what I want to test though is just to use the opening range lines as our loss and our target as the stop. The question is, how do we do that within the builder? First, let me keep up with this variation, because this is our best performing variation. Arguably, let's look at the other metrics. This is the highest profit factor. Oh, it's a close call. It's a close call. But what I want to first do is save another variation. So orb video, save as orb 3. So we want the ATR to get us out in the money and the opening range lines to get us out for a loss. So all we got to do here is on this ATR condition, where the ATR changes to negative and we exit, all we got to do is say we only want to exit when the ATR changes, if the unrealized P&L is greater than 0. So now it's only going to get us out if the trend changes and we're in the money. Okay, and now we got to make an additional set. And we're just going to pop in there cross below opening range high. And we're going to exit long here as well. So what we're doing is, if the ATR changes to red and unrealized P&L is greater than 0, so we're in the money, then we're going to exit. So that's going to be our exit for when we're in the money. Our exit for a loss is if it crosses beneath the various lines that we're going to be testing. So first we're going to use the high, the mid, the low, and the open price. So let's go ahead. So this is our best variation so far. Not sure what you're referring to in this. Let me choose, what did I name it? Oh, that's why I didn't put video in there. It's Orb 3. Orb 3 to 5. Correct, so this first one we're testing, the exit for a loss is when price closes beneath the high. Everything looks good. No. So I guess you kind of missed what the issue here. So if we're looking at this one, really I just noticed there's kind of a significant lag from, you know, the audio to the live stream. So you might actually benefit more only listening to the audio on the live stream. I don't know. It's up to y'all. But with this variation, a lot like whenever we wanted to exit when price closes beneath the midline, well, the ATR trailing stop was above the midline, meaning the ATR stop was getting us out before price ever closed beneath the midline. Whereas what we wanted was for the ATR to get us out only when we're in the money. So we want the ATR to get us out when we're in the money, and we want the various opening range lines to get us out for a loss. Does everybody else understand that? Gold, Reagan, Rock? Y'all understand that? So what we tested before was So I think you're failing to realize what the issue was with what we just tested, right? Look at what we're looking at the screen right here. Look at where we entered and where we exited. We exited on the ATR change for a loss. Do you understand that? We only want to exit on the ATR change when we're in the money. And use the lines as our exit for a loss. Well, I just made a variation where it does work. So now we're going to test that variation out. Because right now, with the variation we just tested, the ATR was still having a dual stop loss effect, where it was getting us out for a loss and sometimes out in the money. But that's not what we want to use it for. Only our initial stop, being one of the opening range lines, will get us out for a loss. And now our ATR stop we're using as a trailing stop for whenever we catch those big trends. So, the moment of truth. Let's see if this variation does better. Let's test it out on the 5 minute. We're going to make sure it's working right on the chart. So not that good on the 5 minute. So this is whenever we exit for a loss, whenever price closes back beneath the opening range high. So here we exited for a loss, here we exited for a loss. So I want to find a scenario. Well, I don't really need to find one, but it's probably not going to happen that much because we are using the opening range high, and the ATR is essentially always beneath the opening range high. So anyways, let's move on to the 4 minute, but it'll be a lot more prevalent when we look at the opening range midline and the low. We'll see that effect that we just made a variation for. All right, don't even need to test out a 2 minute. We already know the opening range high isn't where the sauce is at. Let's change it to the mid, where our premise is more exploited. Let's make sure I did that right. Make sure I chose the right line. Opening range mid. Cool. Let's choose the 5 minutes. Okay, so right off the bat, we can see here what we fixed. So look at where the entry was. So right now we're using the midline. In the other variation, we would have exited right here when the trender, or when the ATR changed. Whereas where we want to exit for a loss is when we cross beneath the midline. So since we weren't in the money, the ATR didn't get us out. So hopefully now with the illustration, it's perfectly clear what's going on. Let's go ahead and choose the 4 minute. $67,000 with a $5,000 drawdown. Definitely not that bad. It's actually our highest profit yet. Let's see what that ratio is. So the ratio is smaller. Not a big fan of the smaller ratio. So yeah, given the fact it doesn't have a better ratio, I'm going to be giving that one the boot. Test out to 3 minutes. 59,000 with a $6,000 drawdown. Really depends on what stage we're in, but I mean, in most cases, I mean, these things are a little bit subjective, but yeah, I love me a better return to drawdown ratio, and we just got it right here with our best test yet. 66,000 with a $3,900 drawdown. With our highest profit factor, we have 2 products with a profit factor over 2. Let's see what the drawdown ratio is. Right now our best one is 13. And this one is 17. So we're almost up to 20 to 1. And this is just the core pattern. Just the core pattern. We're at 20 to 1, almost. Right now it's 17 to 1. Just out of curiosity, I'm going to test the 1 minute, so I'm going to save my workspace in case catastrophe ensues. Let's go ahead and test out the 1 minute. Yeah, gold, and that's what a lot of people think, and that honestly holds a lot of people back. In almost any field, simplicity is always king. So 1 minute is not better. 2 minute is now the sauce. With just a fan-freaking-tastic metric. Now, sample size is small, so I expect, it to not be that good once we increase in sample size. But this is definitely our best initial pattern so far. And so this is where we're testing the midline. So now we're going to go in real quick and test the low. 10, include commission, aggregate. Why'd I choose this date range? It's completely arbitrary for the sake of this live stream. If I try to do larger dates while I'm streaming, NinjaTrader will probably just freeze and start doing some crazy shit. or we'll just be staring at NinjaTrader for a long time, talking about nothing. But for initial testing like this is still just the initial testing of the pattern. So you can do a pretty small date range. But once we start looking to actually improve it, then we got to start, using much larger sample sizes. Which even then, though, I won't really be able to do that over live. I can't do like a 5-year test and get 30,000 trades like while I'm streaming. CPU might have a heart attack. Let's see. But for initial testing like this, just see how the pattern's working, testing different variations of the pattern to see, okay, what's the best way to kind of quantify this pattern before we start, trying to add some more to it. Can it go downhill after successful initial testing? Yes, it can. Normally what we'll see is, if it's a good pattern and you're not overfitting, it's just good, robust, simple entry, then it's just always going to perform good at certain times on certain assets. And that's just the case with any strategy. All you need to try to be aware of is it a pattern worth exploiting, worth waiting for? What's the type of risk to reward in this pattern? Is it capable of giving us massive wins, or is the wins pretty mediocre compared to the average loss? Is the pattern worth, trying to exploit? And that's what initial testing is all about. We already know the opening range breakout is a pattern worth exploiting. It's a foolproof pattern. It's been around a long time. It gets massive attention by the entire trading world. Indexes, the most commonly traded futures contracts. So everybody's looking at the freaking opening range breakout. Algorithms all day long are trading around the opening range breakout. And so once we get all these variations, see which one's best. Then the question is, well, which opening range performs best? 15 minute, 10 minute, 20 minute, 5 minute. With using actual different ranges, I think those are good actual strategy variations for deployment. So maybe have, just a good robust system for the 30-minute range, have a good robust system for the 5-minute range. Get you some good diversification there. Maybe run those systems on different time frames, reduce the correlation even more. And then we can see, is the 30-minute opening range superior to a different 30-minute range? Or can we use this premise on any 30-minute increment? What about the, the 1 p.m. to, 1:30 p.m.? What about the 2:30? Maybe a good power hour play. There's just so many ways. Honestly. No, I do not. Honestly, it wouldn't even make sense. Since we're trying to exploit patterns, patterns are made by the crowd. I was only saying that because if you think about it, you know, if we found some, I mean, I'm not saying there isn't like, you know, secret patterns, but everybody's looking at the same thing, you know. And trust me, there's so, like, even though, like, let's say the opening range breakout is so common, I mean, it's probably like the most common. Um, you know, as far as like intraday strategies go. The just lost my train of thought. I had it. Where was I going with that? Saturation. Um, oh, I know where I was going with it. So, since there's infinite ways to go about trading the opening range, it doesn't mean everyone's going to trade it the right way. Since trading's a zero-sum game, you know, there's going to be, I mean, no other way to put it, there's going to be plenty of money to take away from other traders. And chances are, the way that you're trading the pattern, verifying it with data, the way you're trading the pattern is the original method. So your original method is avoiding the saturation of the way other people are trading the same pattern. Because everybody can trade a breakout. And breakouts will always exist in any market for the rest of time. Now, how all the individual traders are trading that breakout, you know, and people trading that same level on all different types of time frames, and just so many factors that go into play. It's too much to fathom, to be honest. So let's head over and real quick. This is using the midline. If I am, no, this is using the midline. It's the opening range. So our best result now is using the midline. Opening range mid. I'm having to say it so that I don't get confused, having to keep up with the conversations, doing the strategy, trying not to get confused here. So now we got to go to Analyzer 3, which was our previous best performer, and just change it over to opening range low. Let's make sure it's correct. Range low. Go ahead and compile. Let us see if the opening range low gives us better results. Whew. So let's realize what's happening here, okay? We're using the opening range low as our stop loss. And we're entering on a break above the opening range high. So why would that give us more, I mean, you have more profit, we have more drawdown. We're basically eliminating any constraint. I mean, there's still a constraint. We could just say we enter and just exit, you know, no stop loss. But as of right now, this is pretty extreme measure. So we're allowing a very large amount of room for the market to play around before exiting us in the money via the ATR change. So what that means is obviously the chart we're looking at here is worst case scenario. I mean, really, just enter, it comes all the way back down, stops us out. Turns out it was a fake out, up it goes. I mean, really, this is as bad as it gets. But in a lot of other scenarios, you don't even need to look at the charts. There's going to be a lot of times when price will break above the opening range high and just mess around all over the place. However, not cross below the opening range low and eventually go in our favor. And that's why essentially we're getting our highest profit yet, not our lowest drawdown. I will see what the ratio is. 74. So the ratio is only 10 versus our best one right now is 17. So let's go ahead. So even though it has the highest profit, you know, I don't really care because I know why it has the highest profit. I just explained why the profit is the highest. And that's really important. When you get results, just try to think about why. You know, why is the profit highest here? And if you do that, you know, after 1,000 times of doing that on tons of different types of strategies, then, I mean, you won't have to look at charts anymore because you already know why. Let's go ahead and test out the 4 minutes. An even higher profit. We're at 80,000 now. And ironically, our profit factor keeps on getting higher. We're over 2 on 3 of our products. However, our profit to drawdown still isn't good enough. I like our 17. Let's see about the 3 minute. Profit factor once again increased, and now we're seeing something better. Because what I like to see, I don't know about y'all, but I like it when our profit goes up and our drawdown goes down. Not profit increase and drawdown increase, because we're not achieving anything there. That's just the same as taking an increased position size. We're getting more profit, we're getting more. We don't want that. We want more profit, less risk. So I'm gonna see what this ratio is here. 79,000 divided by 5,700. 13.8, so not bad, not good enough. Let's test out the 2 minute. Maybe the 2 minute will be the sauce again. Holy shit. That's really good results. 88,000 is our profit, and our drawdown is 3,700, giving us a profit to drawdown ratio of 23. That makes me a happy camper. So we got one more variation to test, and that is going to be using the open price. Yeah, what's crazy is our profit factors on all the products, you know, just Because I mean, I guess it's almost common sense. Um, when you're testing across multiple products, you want to see decent performance because that's the whole point of measuring the robustness. Is it doing pretty good over all the indexes? You don't want an opening range breakout strategy that does great on ES but loses $1 million on NQ. Something might be wrong. Just real quick, I want to check out the equity curves. I don't care what they look like, just out of curiosity. So EMD, very nice. ES, very nice. RTY is the worst, which is normally the case with RTY. Other than that, all of our other equity curves are looking real nice. Nice and linear. Pretty volatile. But normally the performance of individual products is a lot more volatile than, of course, the portfolio volatility. Yeah, that's just fantastic, though. To be honest, the entire, of course, can't give it too much weight because sample size is small. But nonetheless, compared to all of our other variations, this is superb performance. And not optimizing, it's not optimizing anything. It's just seeing different ways to exploit this pattern. So yeah, you asked me previously what gets my attention, and I told you 20-1 or more, and you can tell by the way I'm talking, I get a lot more perky whenever we start dealing with 20-1 plus. Let's go ahead and test out the opening range price. My bad. The opening range open. It's not even, has nothing to do with the opening range. It's just the open price. Let me test back over here. So let us 2.5. Is everything correct? Oof. Gold. You're hurting my feelings, man. I mean, I like that you brought it up. Because this is what a lot of initial traders think. And I don't think I've talked to you specifically yet about triggers and the irrelevancy of them. So just in your spare time, since you know how to work with the strategy builder, a little bit of homework, so to speak. If you found a trigger that gave you a 60% win rate on a 1-to-1 ratio, you'd be a millionaire in no time, right? So think about the RSI. You can use so many different triggers to go long. You can use cross above the 50, cross below the 50, cross above the 80, cross below the 20. You would think if you put a 1-to-1 risk to reward in all these different triggers that, certain ones would outshine the others. But spoiler alert, they don't. And this is illustrated again with, let's say we have, price cross above the RSI with a 1-to-1 ratio, after 20,000 trades, the win rate is 50%, maybe 51, maybe 49, somewhere around there. And then you think, well, what if I only do this in uptrends, right? We added 200 EMA. You'll find that it actually takes that 50% win ratio after 10,000 trades, 20,000 trades, and makes it even worse. Now it's not even a coin flip. And on the flip side, it might actually boost your win rate by maybe 1%. Not enough to give you an edge still. There's still not enough to give you an edge. But in almost all cases, your trigger improves if the trigger happens at certain times, at random times, that it does better when it's below the EMA. And the reason for that, because the market is naturally mean reverting in nature. So taking a long position towards the EMA is better than taking it above, where you're actually going long in a over vast amount of trades in like a mean reverting environment. So in other words, the homework is just start experimenting with triggers and use all of the shit you read online about what's supposed to make a trigger better. And you'll find out that all these little things that are supposed to improve your triggers actually makes strategies worse. Exactly. You said it before I could say it. It falls in line with the constraints. You put these random constraints on your strategy that you think makes it better. In reality, it doesn't. Now, that being said, we can test your idea. Maybe not on this stream. But definitely once I don't think, something like a lagging trend filter will help this strategy. Simply because we're dealing with a range. It's a range analysis type of strategy. But we can still, maybe put the 200 EMA on the 30-minute chart, do a little bit of multi-time frame analysis, just to see what happens. And now we have our baseline, so we can actually see if these adjustments are overfitting the strategy or if it actually makes it better. As we compare it to our baseline, because our baseline is not overfit. Our baseline acts as our comparison, because we know that whenever an opening range breakout occurs, we're going to be in that trade. And that's what we want for the most part. And so now the question you ask yourself, well, how can I add a filter that tells me which opening range breakouts I should take? In most cases, you will fail miserably and do nothing but overfit. However, if we go about it, in certain ways, and there's just a certain way you have to go about it. And even then, you're not 100% sure. There's no way to 100% know if you're not overfitting. That's why, the less you add, the better. But yeah, we'll definitely get into stuff like that. But the first things, the spoiler alert, the first things I look at whenever I look to try to potentially improve a strategy are just the core elements that make up price. And that's volume, volatility, and noise. So I look at these things and I just try to see how I could maybe use any type of leading indicators to say okay, the volatility and the volume and the noise conditions that you need for this strategy to prosper, so to speak, are more likely to occur today than, yesterday. But even then, it's not easy. Trying to actually improve strategies is really hard. So I'm just gonna go ahead and say it. Like starting with the base pattern like this is really easy. Trying to actually improve the edge without overfitting is very difficult. And even then, you always have to ask yourself, is this overfit? But so yeah, if you keep it, if you follow all the steps that we're going to be doing, it's going to make it very hard to overfit, and that's what we want to do at the end of the day. We want to make it difficult to overfit. And right off the bat, we're doing that with limiting the ATR to a very specific optimization range. We're limiting, or we're basket optimizing, so we're getting robust results. So every step of the way, we're gonna ask ourselves, is this something? Does this make sense, or does this just overfit? Do you think a weak open range or month open range as a filter? I don't understand exactly what you mean by that, but that's a good question to ask, and we can start having conversations like that over in the orb channel, because we don't have any conversations going in there yet. So it'd be good to start trying to come up with some potential ideas as a community, So let's go ahead and test out this open price. I think we've already compiled. I think we're good. Over here on the analyzer, everything looks right. So let's go ahead and run it on the 5 minutes. No good on the 5 minute. Well, no good in comparison. Yeah, absolutely. Focus on the orb. I think most people would want to focus on the orb anyways. Obviously, everybody has their side projects, but everybody. Yeah, everybody. Nothing else, just everybody. Let's test it out on the 3 minutes. So honestly, using the open range or using the open price is doing really, really well. It's definitely second place. Next to the opening range low. I mean, real good results, but opening range low is going to take the cake. So super cool. We have successfully, I can go ahead and close this analyzer off, and we decided the opening range low is doing the best here. And now I think we should talk about why the low did the best. Because whenever, this is a really important concept, I think. When you're initially testing out a pattern and you're thinking about where your initial stop loss should be, logically, it should be at a level that would completely invalidate that pattern. Okay? I'm going to draw a little picture to illustrate this, but let's pretend it's a trend strategy. So let's say, market is going in an uptrend. It's just doing its thing. A lot of people's strategies, due to constraints, will begin stopped out at random areas, just wherever, and then not even profit on the uptrend. So let's say you want to profit on a casual, it's what I call a casual uptrend. And the way we can quantify this is you have a strong uptrend, a casual uptrend, and a weak uptrend. So simplest way to quantify this is if we have three moving averages. So a strong uptrend, if blue is price, and let's say this red line is a 20 period moving average. Okay, so a strong uptrend is not going to dip below the 20 moving average. Okay. And the same thing, I guess I don't have to draw it again, but pretend that this line is now the 50 moving average. The red line is the 50, and this orange line is the 20. So now we have a casual uptrend where price is going beneath the 20, but we're staying above the 50. Then obviously the last step is let's add another one. Let's say we have the 20 right here, right? This is a terrible illustration, but you can see what's going on here. So let's say the green is the 20, the 50, or the orange is the 50, and the red is the 100. So a weak uptrend will be crossing beneath the 50 and of course the 20, but stay above the 100. Just three simple ways of quantifying the strength of an uptrend. And so the point, and why I'm illustrating this, is let's say you wanted to make a strategy that was based on making money on a weak uptrend. So if you're trying to quantify this pattern, then the only logical stop loss would be if price breaks beneath the 100 EMA, okay? Goes in this area. If you're getting stopped out in these random areas due to constraints, well, now the market pattern that you're trying to exploit occurred, but you didn't make any money on it. And so with the opening range breakout, here's the opening range. We break above the opening range. Turns out using the low as our stop performed best. And it makes sense because that would completely invalidate the opening range breakout, whereas the midline Well, yeah, just the midline, and I guess we can say the open's right here. The open can be wherever. It could play around in those areas just due to noise, and still, end up keep on going up. So that's why, in my opinion, the low ended up working best, because it completely invalidates the setup and what the pattern that we're trying to exploit. Now, if the pattern we were trying to exploit was like a opening range breakout, and then following that breakout a strong uptrend, well, then the only thing to quantify is we have a 20 period moving average, and then after that breakout occurs, price stays above the 20 period moving average. Now, we don't even have to test anything for the most part, because we already know this wouldn't work out very well. And why is that? So the pattern we're trying to exploit, hypothetically, is price breaks above the opening range high and keeps on going, staying above the 20 period moving average, a very strong trend. Why wouldn't, I'm legit asking y'all a question, why wouldn't this work out very well over many trades? Simple question, simple answer. Not quite what I'm looking for. I've said it many times. If you test an initial pattern and the initial testing is no bueno, it means that pattern, fill in the blank. Close. It's a real pattern, for sure. When we're trying to exploit a pattern, what is it reliant on? The pattern has to close enough. That wouldn't work because the pattern doesn't occur often enough. It doesn't happen enough. As simple as that. If this pattern occurred 5 times a week, when price breaks above the opening range high and it keeps on going, well, I mean, shit, trading the opening range breakout would be the easiest pattern in the world. But it doesn't happen often enough. What does happen often is price likes to break out of the opening range, play around, dance to the music without breaking the opening range low, and eventually going up to the moon. That happens often. That is why it works. But wait, and this, let me stop you there. You're already kind of coming toward, I mean, for this specific setup, we don't want to do that. However, this offers a great opportunity for a leading indicator. For example, let's say we use a Boolean to say price breaks the opening range high, set the Boolean to true, and then wait for a different setup that takes place inside the range to look for an entry. And that would be a great variation that might also be very profitable. And that gives you a sense of leading indicators. And also why I don't like lagging indicators. We're going to go in the future, we're going to look at how to create strategies, not for the purpose of using them, but strategies that are designed to assess assets, to get a feel for their market environment, and possibly exploit other patterns. But yeah, we can definitely do that, and that might be a good variation, you know. Because if that pattern didn't occur pretty often, then we wouldn't be seeing these results on the 2-minute chart. We would see price break above the opening range high and then play around and then eventually stop us out. And if that happened more often than it does eventually going back up, then once again, I don't have to, I'm pretty sure all you are getting the point here. But look at how important answering the question why truly is, because we didn't just roll with this best, we didn't say, okay, this variation is the best and then move on to something else. We looked at why this variation occurs, or why this variation is performing best. And after fully realizing why it does, opens up new doors and gives us a whole better understanding of how this opening range operates and how this pattern works and how to fully exploit it. And now we can potentially exploit it in a different way that could actually add diversification. All right, final questions, and then it's going to be a wrap. So the EMA would be struggling here because it'd be a constraint. There's going to be a lot of scenarios where a amazing opening range breakout occurs, but guess what? Gold ain't going to be in it because it happened while it was underneath the EMA. And I'm going to be like, gold, why didn't you bake on this 100-point breakout? Like, oh, well, it wasn't beneath the EMA, man. And then the next day, it is above the EMA, and you take 5 losses in a row. Like I said, that's just the nature of just using filters like that. It's just if you run a test and it does give you better results, chances are it's just random chance, and then it's just another version of overfit, and then once again, like you said, you just want to quit. Yeah, we want to add to the robustness, you know. And if we can't add, like since we have our baseline with no constraints, then we can properly assess, you know, if adding any, you know, little adjustments are really even worth it. And, you know, and maybe they're not, you know. But I think the next thing we're going to look at is the potential idea I posted over an orb and what I was talking about with flare. I can illustrate it real quick actually because it's a very interesting concept and can be translated to so many different strategies. Just real quick, show you. Let's pretend that, yes, and so let me show you why this works using a smooth price signal. We're going to say this purple line is the raw price. It's a line at close. I don't know if you know, if everybody knows what that is. A line at close. It is a line that only follows the close of price. So we're going to say it looks like this, you know. Just kind of plays around. Now, the close price went above the opening range high several times, but got knocked down by sellers, maybe traders taking profit, whatever. Whereas if we used a tight, smooth line that had a little bit of lag, you know, it kind of looks something like this. It would look just like that. I know exactly how these freaking things look. It would look something like that. And so we would have never gotten that signal, and all it does essentially is give us a slightly more confirmed signal once it finally does break above. And I'm not talking about using some freaking 50 period moving average that's way down here. You know, that's way too much lag. This is just a slight tweak, you know, exactly. The whole point of smoothing is to ease the noise. It's tweaks like that that can make a huge difference over the course of 1,000 trades, you know, or 10,000 plus. And it maintains the robustness of the strategy. It doesn't take away from anything. We're still going to get in every time a good opening range breakout occurs. Slight tweak maintains robustness. Nothing's overfit. Just a slight tweak to the trigger. And then we haven't even added any money management on yet. We haven't even added, you know, potential scaling or adding to winners. And then, right now, at this point, I'm just spoiling stuff. But no, I'm not going to say it. I'm not going to say it. But there's a lot more in store for this strategy. You know. So I'm going to go ahead and wrap up there. Session is not meant to be this long, but it's hard to not get carried away. So cool. I'm gonna take a screenshot of this summary, because this is our current, you know, best results, and tomorrow we can look at adjusting our trigger a little bit. So I hope y'all have a good one, and I will catch y'all in the morning. Well, the morning for me, I don't know who's going to be there, but it will be recorded, and hopefully I can fix this blurriness issue. It's cool. I'll talk to you guys soon.